Now, United Capital recorded a 35% year-on-year growth in revenue, hitting 58.5 billion naira in the year 2025, while profit before tax grew by 37% to 41.18 billion naira. Now, according to United Capital Group, the result was primarily propelled by growth in net trading income and growth in fee and commission income. Ejikeme Okoli, Director for Africa Regions at United Capital Group, joins me now to unpack the numbers, near-term growth prospects, and much more. Thank you so much for joining us on the show today. Ejikeme, interesting numbers we have here: 35% growth in gross earnings and also 37% looking at profit before tax. How much of this growth is structural, and how much of this reflects the sort of expansion we've seen in terms of your client mandates and cross-border deals?
Okay, thank you. It's great to be on the show once again. First time being on the show since quite a while, especially considering the unfortunate incident which plagued United Capital last year. So for us, the numbers are a validation of not just the resilience of the business model, but the goodwill we have from our teaming stakeholders, especially our internal stakeholders, being our employees, our colleagues, who held the business, especially in the fourth quarter, amid the unprecedented event which plagued United Capital, where we lost some of our dearly departed. So I'm dedicating this interview to them to say the company is still in great hands and will continue to forge ahead in honor of the work that they have put in and ensuring that at least their service to us, to the country, to the investing public was not in vain. To answer your question more technically, a lot of it deals with the business model, especially in the first 9 months of the year, because in Q4, the numbers for us are humbling. Humbling because, not because we didn't set out to achieve what we achieved, but by the third quarter, we felt, okay, between now and year end, it's in God's hands, knowing that we suffered a lot, knowing what happened to us. But like I said, the resilience of the business model, the goodwill from our clients, the investing public, the broader stakeholder groups that are associated with United Capital. So this is just a testament to show that, yes, we appreciate the patronage, we appreciate all that has been done to ensure that the business, remains resilient and stable. And from the numbers you reeled out, the bulk of our growth came from expansion in fee income, which is advisory fees, cross-border transactions, a few deals we closed within the country and a few outside the country as well. And as well as the growth in our mutual funds, which, it's a fee-based business. Our mutual funds now, hovering around the 1 trillion mark, which we expect to cross this year. So that has been significant. So yes, it shows we still have goodwill in the markets that we operate, and the business model is highly sustainable. We expect even better numbers this year. Okay,
talking about the expectations, because I was going to ask how much within this your energy mix is sustainable when we're looking at the sharp rise we had in fee and commission income, looking at the rise there and even trading income.
Yeah, a lot of it is very sustainable. For trading income, you'll see how the equities market has begun this year. A lot of it has been relatively bullish, and given that we are capital market operators, capital market largely comprises fixed income and of course the equities market, which we play in both markets very actively. We expect an uptick in what we've seen, especially in the tail end of last year, to continue well into this year. So stakeholders should be rest assured that the numbers are very, very sustainable.
But if you were to speak to the specifics, looking at the capital market and also the deal pipeline now, where do you expect the most deal flows? You've talked about mutual funds and all of that, the equities market, sovereign funding, corporate debt issuance, infrastructure financing. How do you see the spread going?
I think it's a mix of all of them.
Okay.
So in terms of the interest rates environment, you see that rates have relatively declined between the tail end of last year well into this year, in terms of where the investing public sees interest rate, not necessarily on the MPR side, because there's been a slight decline, especially in the last meeting by the CBN. So what this means is it favors issuers coming to the market. You can say get debt cheaper than you would have if you had issued notes or debt papers, say, a year prior. Yeah, so we see that as encouraging. So what that means is there are likely to be more issuances this year on the corporate space, even on the governmental space. We see infrastructure projects, also being a major driver in terms of capital raising transactions, largely because when the economy is stable, the real sector is what becomes the main driver, and not necessarily portfolio investments. And the real sector, a lot of that income will come from infrastructure projects. We expect a lot more large-scale industrial companies to also be listed on the exchange this year, at least from feelers that
So
we're
these
getting.
all the catalysts you think would help you also cross that 1 trillion naira threshold you initially talked about nearing last year?
Yeah, so the 1 trillion is on the mutual funds,
Yeah.
a combination of all the funds that we have, from equity funds to fixed income funds to balance funds to children investment funds. And now our funds not just are they targeted at the asset class that the money will be invested in, but it's now also targeted at unique segments of the economy, lifestyle segments. Because what we found out was that financial inclusion, especially on the investment side, has been relatively low. Not because there isn't enough money to play in these markets, but because the investing public needs to be educated on how the theme of investing, the habit of investing would benefit them. And most times you need to be innovative in even how you name your products so people know that you are talking to them. So a children investment fund, for example, may still invest in bonds and equities, but the investing public, they know, okay, you're telling me that I should set something aside for my child's future. So that is also informing us on the kind of new products you're going to be hearing from us, not just in Nigeria, but also across the African markets where we operate.
Yes, and I like the fact that you're also talking about new products as well, because I had a conversation earlier today looking at how our pension fund administrators are also revising their strategy around asset allocation and looking at the global picture around diversification. How is United Capital also positioning when we are looking at the mobilization of pension capital as we see it today, and then look at the broader ecosystem along, say, for example, West Africa?
Yeah, so the way we see it for Nigeria, it holds huge opportunities for our business. Before I came
because
for
we
this
still
meeting,
largely play domestic.
Yes, we play domestic because regulation is domestic. So we have a lot of products that should allow us invest beyond the shores of Nigeria. But from a regulatory perspective, the regulators
somewhat limiting.
Yes, it's limiting, and it's understandable because you also want to develop your capital market. If the bulk of your investing public is playing in your market, then in terms of ranking, compared to other markets, it bodes well for the local economy. So from the regulatory standpoint, in terms of regulated products we'll be bringing to market, we know the bulk of it will still be in the Nigerian market, and where we have the leeway to play beyond the shores of Nigeria, we can list those products on other subsidiaries. But speaking to pension funds in particular, we're having a performance review before I had to jump on this interview, and one of the key highlights was how we should position to ensure that the pension funds in the country are not just deployed, given the opportunities that the new act has allowed pension funds to increase their stake, especially in equities. And regardless of how pension funds will play in the capital market, whether it's in fixed income or in equity, we play in both sides. So we're already creating products that are targeted, to this pension fund administrators to ensure that our capital market has breadth and also has depth, and will be able to absorb the huge chunk of funds that we believe is coming in. So
and talking about the huge chunks of funds that's coming into, the move towards Cote d'Ivoire, I was just like, okay, well, that also captures the Francophone market over there. But in terms of the broader picture now, should we expect some acquisitions, looking at your next line of action when we are looking at United Capital's strategy in terms of scaling this whole regional move?
Well, our preference has always been organic. And so that's the much, I can say here. Our preference is organic, being starting businesses from scratch, obtaining licenses where we need, and then some form of partnership. Outright acquisitions, maybe where we see rare opportunities, we will, but our preference in terms of our strategy is to build businesses from scratch, because that way apart from the business opportunities or the financial opportunities that come with playing in a new market. What we also see in terms of acquisition is dilution of culture. So you also want to build businesses where your DNA is transmitted from the onset, because we are not just playing to meet our year-end numbers or 3-year numbers. We are building to last. And in building to last, you also want to create from scratch, nurture, and ensure that the adult businesses that will emerge are a replica of United Capital PLC Group.
Okay, Ejikeme, we'll leave the conversation here for now. Thank you so much for your time. That was Ejikeme Okoli, Director for Africa Regions at United Capital Group.